move to the big market conversation, and we have a very exciting guest this morning. Nitin Bhasin, Head Institutional Equities at Ambit, joins in. Nitin, always a pleasure to speak with you. Wanted to know what you're making of the results, because we were having a bit of a debate this morning on whether it's a curate's egg. Are they good, bad, or a bit of a mix? What are you making of it?
The most often used word in the markets is mixed. So let's stick with that as mixed.
Safest.
Mixed. Clearly, no clear trends. I think number of companies which have released the results is not considerable enough one to actually form a view on that this is what's playing on. But definitely you are getting some cues on sectors like IT, some cues on sectors like banking, lending, credit growth. I think some specific sector cues are emerging, but for the overall as a country, I would say not yet. I would not form an opinion based on these results.
Okay. Nitin, good morning. It's been a while, but good talking to you. What's the skeptic argues that for the kind of growth that is evident in the last couple of years, or it is last year and possibly this year, the valuations are expensive. The optimist says that post-COVID, the average multiples have been about 24 times, and therefore at 24 times for an economy which is growing 6.5%, CAD is positive, etc., we are not expensive. Are we expensive to your mind, or are we not?
So yes and no both. If you look at the banking sector, appears to be again yes, and if you look at the banks, definitely appears inexpensive when you look at the last year's numbers. But if you look at the Nifty X banks or Nifty 100 X banks, and what you could see is the whole market at the large caps relatively is expensive. But markets don't move to valuations. Markets also move to what is the expectations and how are the market results coming out or numbers panning out to the expectations. And clearly, one has to follow what's happening on the upgrade or the downgrade cycle with sectors, what's happening to the upgrade and the downgrade cycle. So clearly, what we are witnessing right now is though banks may be relatively inexpensive, performed very well in the last 1 year, but they are going through their own June quarter, perhaps even September quarter to some extent. Sort of a moderation in credit growth, continued pressure on NIM or expected pressure on NIM, and hence margin pressures possibly over there. So I would say mid cap, small cap appear relatively more expensive to large caps. Overall, the whole market to its own history is expensive, but the flows in India, remember we have keep on talking about this in the past, the flows in India are strong, which is domestic. Hence, that is the elevated new price earnings multiple of India. And
can I ask you on that? Because I know that you go out a lot to meet global clients, right? So what is the FI view here? Are they waiting for something to put in money into India? Anything that insight that you have?
So in the last 2 weeks, meeting clients across Singapore, Taiwan, Hong Kong, what you get a sense by meeting them is again, depending upon what capital, what color of capital or what length of capital duration they have, but clearly not overtly optimistic buoyancy. Not many people sitting and saying, hey, India is very inexpensive and one should be actually putting a lot of money at work. We also see in the print that after a few months, FI volumes or FI flows have again turned negative. I did not see sense of exuberance, sense of optimism that everybody is jumping out of their chairs to buy India. On the sides, pretty cautious, I would say, and realistic that in these valuations or in sort of a slowing earnings EPS growth environment, one should be picking stocks. I would say that little somber mood of the institutional investors, even in South Asia.
Driving that caution, Nitin, that you are sensing? Any specific indicators or a sense of fatigue as well on the India story? In your view, where is that caution coming from?
I think we as market participants read the tape also, read the economy also. And if you can see that for a while now, Nifty has been oscillating between 24, few hundred points and 25, 500, 25, 600. I think the market's also trying to find for itself a direction given, because there are mixed signals where petrol consumption in India may be still tracking the GDP growth, but at the same point in time, there are so many other indicators which may be highlighting that the economy isn't actually, bustling ahead So hence, because of which estimates, we spoke about this last time as well, in this fiscal of FY26, earnings estimates, below 10% for Nifty is one of the lowest ever. And in that scenario, downgrades or upgrades are not very consistent. So market is trying to find itself a feet, which direction to go to. So that's how I would answer that.
I want to come to this note that you've put out and where you focus on price momentum. I think in the context of what we've been speaking, where there's a lack of clarity, etc., why do you think price momentum is an important indicator when you're picking stocks? Let's just set the context for that.
Sure. This is based on a paper written in the developed markets, price movements of stock prices. Multiple times, we are looking at which stocks to buy, which stocks to sell through different strategies. Some are fundamental, some are quantitative. Even price by itself shows. So what we discuss in this note is a brief and a not that well understood concept that over a period of time, two stocks can actually move and deliver similar cost sort of returns, whereas the trajectory of the price movement of the stock also speaks. Some stocks can move very widely up and down, and some stocks move slowly. The strength of the trajectory from point A to point B shows you what is the strength in the stock price momentum. Every price momentum is not similar. So what we do is we highlight for clients following, trend following, clients following 1 to 2 quarter strategies, what sort of ideas to look at using a tool. This is that tool we've put out for the use of clients. They can actually marry this with earnings upgrades. They can marry this with earnings estimates, revisions. So this is what it is. We highlight a few stocks, 7 or 8 stocks in this particular analysis for our clients.
Let's actually come to those 7 or 8 stocks. Bharti Airtel over there, we can see Indigo and quite a few others. Is the basis largely on price momentum?
Yes. As market has multiple sort of analysis, in a market like this, where we've been highlighting that it's a stock pickers market rather than a trend market of the index or indices, or for that matter, sector. This is another way to look at what is the price movement, and should one use momentum, what should be the reason and how one should be using the price momentum to focus on these stocks. Separately, we also took names of a couple of names like Bharti and Interglobe. We recently covered Interglobe in the as a fundamental coverage also, and we as a house are positive for the reasons such as a secular demand, industry structure with only 2 players, and the rising increase in share for the Indian airlines, especially for the international traffic. So that could be a bull story for long run, but price momentum speaks for the near term as well.
Okay, I noticed that you don't have any platform companies on that list. And yes, the Interglobe story, I agree, a lot of people coming in and speaking about it. I'm wondering what you're making of the platform companies back in flavor, I would say.
No, for sure, platform as a company, or every company wants to become a platform company or position themselves as a platform company in India right now or across the world. We find all the platform companies, the more so which are discussed, such as an Eternal or a Swiggy, to be expensive right now. The kind of optimism that we hear, how the valuations are moving from FY30 based, SOTP based, anything is possible based. I think those sort of arguments are now coming through in companies such as Eternal. Great franchise, great business, great founders, but at the same point in time, what has to work out, everything has to work out for them, and no, it has to work out nothing for anybody. Perhaps those sort of valuations are visible today in Eternal. So we are relatively positive on companies such as Make My Trip or Paytm, rather than companies like Eternal and Swiggy. Presently, our analyst team finds them pretty expensive on the valuations. On the other hand, I would dare say, just about a month back, we had put out our note on banks versus IT, overweight on IT. I would say, could it be the time right now to look at IT services, which have lost market price performance or sector price performance to these new age tech companies? So relatively, I would say to own IT services for the next 6 months to 12 months over a Swiggy or a Turner or the new age platform companies right now.
Anything specific in IT services you can identify for us?
We've been highlighting a few companies like Tech Mahindra, where we see that the valuations are supportive and there is a scope for margin expansion as the company goes through, sort of a rearrangement of their operating structure, improvement in their cost, etc. So Tech Mahindra could be one, but that is the name that comes to our mind. Companies such as a few ER&D companies, but largely that's one name that I would like to highlight. We are positive on right now.
So quite a few ideas there. Nitin, absolute pleasure speaking with you. Thank you so much.